Every Friday at lunchtime, we're here. And this show really focuses on talking to people about wealth building. And when you think about wealth building, there's also wealth protection. And this really helps you protect the wealth that you've accumulated. Wouldn't it be a tragedy to get to an age where you are enjoying your life and have something happen, whether it's illness or accident, and have your assets impacted because you didn't take out long-term insurance? And so I want to go into that aspect of it, Cynthia. I want to talk about the financial aspect of it and what are the differences between Medicare and long-term care insurance, and what is covered by who and how, because that's where everyone gets confused. I know I do. So could you explain that to us?
That's actually a very great question. Again, there's a lot of misconception here, and with this information that I will provide you, you'll have a better understanding of how much long-term care is. So here in Los Angeles County, you're looking around, if you live in a nursing facility, you're looking around $260 per day. $260 per day is roughly over $7,000 in 1 month.
That's more than a mortgage.
Yes.
Most mortgages. You could live in Beverly Hills if you could pay $7,000 a month.
Right, right. And think about it. This is just long-term care that you're getting. So in a year's time, if you stay in a nursing facility, you're looking at close to over $94,000. So talk about a financial burden if you do not have the plan. So again, this is not something where a number that just I came up. What I did before when I started, and especially definitely going into this long-term care insurance, I actually went to different nursing facilities just to verify myself how much it is going to be. And sure enough, you're looking, that was about 4 years ago. At that point, you're looking around $200 per day. Now, mind you, the cost of nursing care in Los Angeles, in California, increases around 5% every year. So you're looking at $260 per day right now. I don't know, 10 years from now, you're looking at probably another $100 more, so $360 a day per more. So that's the cost of long-term care. And the statistics is around 44% of the individuals getting long-term care would actually stay in a nursing facility at least for 1 year, and the rest at least for 5 years. So 5 times $94,000, you're looking at $500,000 of nursing care.
Of nursing care.
Now, some people want to get care at home. A typical caregiver right now here in Los Angeles County is around $20 an hour. So $20 an hour is $240 per day. So again, you're looking at numbers close to $90,000 per year just for long-term care, whether you get it at a nursing facility or at home. So it's really, really very costly. If you don't have a plan for that, it becomes a financial burden. And again, your wealth, I mean, what wealth?
What wealth?
Exactly.
Right.
If you don't have that planning, wealth is gone.
So here's another question. Just staying on this topic, so now we've established that it's almost $100,000 a year.
Yes.
And within the next year or two, it will be $100,000 a year. And then people think that Medicare covers that, or their personal private insurance covers that. And could you speak to that? Because I know you and I had this conversation, and you know, Medicare, if you don't have employment or you don't have your own private insurance, and then those who have their own private insurance, and some people are fortunate enough to have both.
Right.
So what would be the breakdown? How do you break that down? Like, what does Medicare cover? What does your own insurance cover? And then how does, you know, long-term care insurance, how does that support that?
Okay. First of all, if you are under the age of 65 and you have health insurance, my suggestion is check your health insurance plan. Some health insurance plans do not include any kind of long-term care subsidy. So if it doesn't and you're under the age of 65, guess what? You have to pay for the $260 per day. Now, if you're 65 and over, you have Medicare. So how does Medicare work? For Medicare, as long as you've been hospitalized for at least 3 days and the doctors find it that it's easy for you to get your recovery at a nursing facility, after 3 days, you're transferred to a nursing facility. From day 4 up to day 20, Medicare covers for 100% of your nursing facility costs. Now, from day 21 to day 100, Medicare will only cover beyond $154, meaning you have a copay of roughly $154. This is as of 2015. Again, every year it could decrease. It just depends on how much funding there is in Medicare.
And it's $154 copay per day.
Per day. So anything beyond that, Medicare will cover, but only up to 100 days. After 100 days, if you still are in a nursing facility, you are on your own. You have to pay for that. So that's Medicare. And again, if you're under the age of 65, please check your health insurance coverage. Some of the health insurance plans do not even cover up to 100 days.
Wow.
Yes. Okay. So another option, how do you pay for long-term care? So again, there's Medicare, just part of it. Mm-hmm. Now, second of all is if you do not have enough assets, you could actually qualify for Medi-Cal. Medi-Cal is the only government plan that has a subsidy for long-term care. No days, just, they will just give you the subsidy for that. Now, how do you avail of Medi-Cal? It's best for you to talk to a health social worker to give you how you qualify for Medi-Cal. But basically for Medi-Cal, as far as I know, you cannot have assets more than $2,000 in a month in order for you to avail of Medi-Cal. So what happens with Medi-Cal, if the government decides to give you 1 year's worth of long-term care, which is roughly $100,000, when you die and if you have a home, that will be a lien against your property because the state of California will try to recover any kind of benefit that they have provided to you.
Okay, so back up, because now you're talking about taking somebody's house.
Okay, yes, yes.
So now you know, wait a minute now. We were fine until you tried to take the property.
It's all about recovery of the state of California.
My goodness, so you mean that they will attach a lien to the property? And see, people need to hear this because I know this, but the first time I heard it, you know, your heart skips a beat.
Yes.
So your property is attached.
Yes.
And so upon your,
upon your death, and if you still have a surviving spouse or a surviving child, then of course, state of California will not go after the property.
Right.
But after all that, then there will be a lien against your property for the total amount of benefit that the state of California has provided to you via Medi-Cal.
Now, here's a question too. Now, sometimes people downsize as they get older, and if they've incurred this large $100,000 debt to the state of California, and they want to move, let's say, to a senior living apartment complex or whatever, and they're looking at like a profit, this juicy profit from selling up their home. Does the state get involved in recouping at that point?
Just to let you know, there's a 5-year look back. So if 5 years ago you sold the property and you availed of Medi-Cal, technically you do not own anything, but you sold your house and you made all this money. So state of California would look back 5 years to check what kind of assets you had prior to getting Medi-Cal. So it's, yes.
That's amazing. See, I didn't know that part.
Yes.
Wow. Wow.
So they're actually changing it to a 3-year look back, but it's still being talked about right now, but it is a 5-year look back for that. So I tell individuals, just because you sold your property or whatever assets that you have and you avail of Medi-Cal doesn't mean that you're home free. You're not. You're not. They would always look at what you had before. And next thing you know, you'll just get a letter in the mail letting you know, okay, this is how much you owe state of California.
So this is a very important conversation. And so our listeners, I hope you tuned in and listening at noon. If not, this is also something. So if you miss any portion of this, don't worry about it because you can check us out on YouTube. And just go to Lunch with the Finance Bunch. And, we always have our episodes named. And the name of this episode is Demystifying Long-Term Care. So please, if you can't catch it all when you're listening today, please make sure you go back and look at our YouTube and subscribe and ask questions. Cynthia's contact information will be there. You can contact her and let her know what questions you have and go in and meet with her and sit down and really talk about this because this could be something that could change the course of a person's life, either for the bad or for the good.
Right.
And the education is what we need. And we thank you again for coming in to talk about this.
See, my goal here is not to scare everyone. My goal here is just to provide education.
Right, and it's necessary.
Yes, it is necessary. There's a lot of misconception. And when it comes to long-term care planning, that's the last thing in any person's mind.
Right.
I mean, who wants to be sickly? Who wants to be in a nursing home? That's not something that you talk about in a daily conversation. So again, it's all about educating individuals. What are the options they have when it comes to long-term care planning?
Right, exactly. And so like you said, this isn't a scare tactic. This is an educational, informative
Exactly.
conversation, surrounding, what is the misnomer, because really when I was younger, I didn't know anything about long-term care insurance. I thought long-term care insurance when I was younger, I thought that was for old people. That's something that old people worried about or cared about or whatever. I didn't even realize that between 18 and 64, there are more people using long-term care than the elderly. That for the elderly, it can be like a 1 to 5 year. So really, when you're entering into an agreement to pay for long-term care, you're talking about from whatever age you are now throughout your entire life, not just when you're older.
Right. And in any kind of planning, the younger you do it, of course,
the less expensive
it's going to be. So I've talked about different ways on how to basically pay for long-term care, your health insurance or Medicare. So again, if you are not eligible for Medicare yet, please check your health insurance plan.
Right.
It is crucial. So if you're over 65, you have Medicare. The other way is if you have minimal assets of around $2,000 per month, then you could actually avail of Medi-Cal. Okay. Thirdly is if you don't have Medi-Cal, then you could, and Medicare only covers so much, you could use your own personal resources.
Right.
And the personal resources, you use your own retirement funds and at the same time basically force your family to take care of you.
Okay, so now you're attacking the 401k.
Yes.
Okay, and that's a problem for me. That's a problem for people. You're taking the house and, and the personal assets. And, when people, like you said earlier, when people talk about, what they're going to do when they retire, or, as you get older and the children move out and you don't have the day-to-day cost of that. The first thing people think about is I am going to travel.
Yes.
And when my kids get grown and they have a family, I'm going to spend my time with my grandchildren.
I'll buy a new car.
I'll buy a new car, and the grandchildren and I will travel, and I'll just have a great time. And married couples want to spend that time with their family, with their spouse.
Right.
They finally have this alone time,
No.
And then as far as single people, as they get older, you become the golden girl.
Yes.
You have travel clubs and, you go out to dinner and, to the movies and theater and, concerts, things like that. And so, but like you said, the conversation does not ever lead to long-term care. What does that truly mean? Because you think because you have an insurance policy, you're covered. Oh, I have such and such insurance, I'm good.
Right.
And has never read the fine print to see what's actually in there until it's actually needed.
Yes. And normally when it's actually needed, that's when you realize, that's when you say, oh, I should have gotten this before.
Why didn't I get this before?
Exactly. So again, with personal resources, now they're tapping into your retirement account, any kind of assets that you have. And the last way to basically pay for long-term care is to plan for it. There's such a thing as long-term care insurance.
That's right.
And I have it. My son, who's 21 years old, have it already.
Yes.
For the simple reason that it is very, very costly to
not have it.
To not have it, and at the same time, it's the emotional burden of taking care of someone 24/7. That's just way too much.
That's true. That's true. And so, would you recommend for parents who have, adult children who are under, between, let's say, 18 and 25 or so, when they're still in college, do you recommend that parents look into that type of insurance for their kids?
Yes, definitely. I would recommend it, especially when the kids are going to college or they're leaving the home.
Right.
Things happen. things happen, disabilities happen, crazy things happen for the young ones, and there's a huge likelihood that they may need long-term care, or they may be in an accident and now all of a sudden they need someone to take care of them.
Right.
So it is recommended. The sweet spot normally is, okay, so you're young if parents are actually thinking of that. But if the parents think, okay, let them take care of that, the sweet spot is actually prior to turning between the age of 35 to 40.
Okay.
That would be the sweet spot.
Okay.
Of actually getting long-term care. And the reason why I say sweet spot is because the rates for long-term care insurance drastically increase after
Over
age
the age
40.
40. Okay.
And then every year from then on.
Right. Okay. So if you're under age 40, the younger you are under age 40 and over 18,
Right.
the less expensive it is to have long-term care insurance.
Yes.